This is good. The Leo Meister is with us today, boy.
Hey, we're live, brother. We're live. Bring him in.
Good morning, REC Nation.
Bring him.
Good morning, REC Nation.
Hey, Simos.
Leo is in the house. Hi, Leo.
Introduce him to the world, Simos. Introduce him to the world.
Well, to all my beautiful REC insiders, happy Saturday. Happy spring. Spring has sprung, and so has Leo. This is young Leo, and he is looking to make some investments this weekend.
Well, we're going to be talking about this weekend.
He's very concerned about the interest rates.
We're going to be talking about what's happening during the week in the REC world. We'll let everyone know. They should have gotten emails, but I'll bring that up a little later in our conversation today. But you were talking about spring. My wife brought up the weather for the next week as we're going to try to plan some stuff with the kids. And I think we're going to be in the 20s all next week in Toronto. So for everyone else, wherever you're watching, I hope you're going to get that type of weather. It's beautiful as I look outside my office window right now in Toronto. I hope it gets to 20 today, but either way, enjoy wherever you are. It's a Saturday morning. The boys are back. As you guys know, that myself and Simos come on a brunch with REC once a month. And then we also have Tyler Walburn, who I'm sure is in the chats already, asking people where they're coming in from and what they're going to be up to today. But Tyler does his own segment once a month on live here on YouTube for Brunch with REC. And I actually we talk about it a lot internally, but we don't talk about it enough, I think, outside to everyone else. I think his segment, his real story segment, where he actually brings on a real investor that's actually maybe invested into only one property, 15 doors, 150 doors. Maybe they haven't even invested, but they're just in their journey right now of getting started. And he documents, and he does a fantastic job asking questions about what's the process like, what's some of your biggest fears, what's some of the obstacles that you are running into or ran into. So make sure, because right now you're watching us live on YouTube. If you just go a little further down into our past recordings, you can go back to 2 years of Brunch with RECs, but you'll also see the real story segment. And if you're an investor that is okay with sharing and documenting their story, please reach out to us. It's very simple. All you got to do is send an email to info@reccanada.com and let us know that, hey, I would love to chat for 10, 15 minutes. We don't need to make it a 2-hour session where you got to tell somebody your whole life story and a bunch of personal stuff. That's not what we're going to be doing with Tyler. It's really a 15, 20-minute segment, again, about the successes that you're having and the failures. So that happens every other Saturday. We always bring something to the REC Nation. But today, brother, we have to be speaking
about... There's a bunch of things.
Well, with the interest rates you mentioned, I know Louis is concerned about the interest rates. Obviously, I am, you are, our clients are, and then we have the hot stats. But why don't we just jump into interest rates? What's your thoughts? Where's your head at about all that stuff, man?
I have a lot of thoughts. I spent some time this morning. I like to follow the Bank of Canada. I like to follow monetary policy in this country, and over the last couple of days, a lot of news came out in the job market. So with unemployment going down, meaning that people are working, that almost guarantees higher interest and more interest rate hikes. So this whole, I'm not sure if we can take just a high level crack, and people need to understand what's actually happening right now. Why inflation is high. What does that mean for interest rates? Why are they going up at the same time? So if inflation is high, it's not like the bank is trying to bankrupt you. So in order to curb consumer spending, meaning stop spending money, they're trying to slow the economy down from borrowing. They don't want Canadians to borrow right now. In order to do that, interest rates go up, and it has already been effective. The balance is the tough part, because the minute you go too hard on slowing the economy down, if consumer spending stops, then you have a recession, meaning people will be unemployed again, meaning if the cash registers aren't ringing, people will be let go, and then the other thing happens. So there's a hairline balance that everybody's trying to figure out. I'm very proud to be Canadian and very proud of our ultra conservative system, because what people fail to remember is that Canada, being the huge conservative country that it is, has put things in place. And when I'm talking about things, I'm talking about financial controls since Jan 1, 2018, where Canadians, when they were borrowing, and I'm talking about mortgages, when they were borrowing, they had to get approved at a rate 200 basis points above, or 2% above, the prime lending rate. Today, for example, if I were to go apply for a mortgage, the prime lending rate is 3.2 today. It was 2.7, it went up half a point. It is now 3.2. If I walk into any of the big five banks, they're going to ask me to qualify at 5.2. 5.2. So as it goes up higher, it gets harder and harder to qualify. But it also creates a massive, ultra durable, very quality safety net.
Yeah, what you're talking about.
Because if I can pay for $1 million home at 5.2%, that's like 8 increases over the next 2 years before we were to get there, if things were to remain the same. And that's not going to happen. So the media likes to sensationalize things, as we very well talk about all the time. It's our job, in my opinion, my job, your job, and every one of the investors watching, to interpret that data properly, stay cool, calm, and collected, and then, of course, not only be okay with it, but find opportunity within it.
Yeah,
that is what
there's a lot that you said there that can be unpacked, man. You did a great job there, Simos. Number one, for everybody who's watching right now, what Simos is talking about with the qualifying on a higher rate, that was the stress test that came in 2018. But even if we go back further, right? If you go back a decade before that, exactly, late 08, 09, when the rest of the world was going through what they were going through from a financial perspective, the one thing that the world was looking at Canada specifically for was how we were protected through that 08, 09 financial crisis. And a lot of it did have to do with the conservativeness of our banking system when it comes to mortgages. I mean,
100%.
Like we have a lot of clients that make a good salary, great credit, but they still get put through the ringer to get a mortgage. I'm going through the process right now, renewing just one of my properties, and I'm going to be pulling out some equity, and I'm getting put through the ringer, man. The stuff that they need, especially because we're self-employed, there is a laundry list of paperwork that's being requested. My credit's really good. However, it's not like how it was back in 08, 09, what happened in the States, that you could get a ninja mortgage, that no income, no job, like period. If you could walk, talk, and chew gum at the same time, they were throwing mortgages at you. And we've never, ever.
And that's governance, my brother. And that's simply governance. They lack governance. They let the system out loosey-goosey, and they let a bunch of capitalists raise money, borrow against the money that was raised, and they financially collapsed. It's just that simple.
Yeah, look.
So here, that doesn't happen. Our underwriting is incredible.
Yeah. Now, to think that we weren't going to see higher interest rates would be like super naive. If you go back to all the recordings that we done here on our YouTube channel, you'll see the amount of times that both myself, Simos, any of the experts that we brought on, and big shout out to all our friends and guys and gals in our community that came on and discussed what was happening in the last 2 years. But I mean, we had historic historic low mortgage interest rates. You could get 5-year fixed money under 2%. There was like, a 9-month period, a 10-month period, CMOS, where you could get a 5-year fix for like 1.99%. So to think that rates weren't going to go up.
There was the HSBC. There was the HSBC 0.99.
Yeah. Now that's that promotional stuff. What I was going to say was, in terms of something else to unpack what you mentioned about rates going up and inflation. I mean, we have printed here in Canada in the last 2 years more money than we've printed in the last 40 years combined. So, I mean, just let that sink in for everybody who's listening right now, that in the last 2 years, we have printed more money than we've printed in the last 40 years combined. There had to be a for a lack of a better word, a reaction that had to happen because of all that money that got printed. Rates are going to be hiked probably, in my opinion, a few times just this year alone, because they need to bring down that number. I mean, that number of inflation that's being thrown out there is 6.5, 6.2% or something like that. The government likes to keep it in and around 2 to 2.5%. And so I think we're going to be seeing increases kind of for the rest of the year, and maybe even the first quarter of 2023. I don't have the crystal ball. Nobody does. But it's going to be very interesting to see. The Bank of Canada is meeting, I believe, in a couple of weeks in mid-June to make the decision on what they're doing. But some of the murmurs are that they're going to go back. They're going to do another 50 basis points increase, the same that we just saw a couple of weeks ago in mid-April. But what's your thoughts and kind of what are you thinking might happen with rates for the rest of the year, buddy?
I definitely think we're going to be in store for 2 or 3 hikes. Contrary to what I thought a couple months ago, I thought we were going to see 2 max. We've already seen 2. And at this point,
3.
With things developing the way they are, sorry, it was after the first one just had happened. I thought 2 more. And now I was thinking 1 in June, 1 in August, September. They've already happened. So I think there's at least 2 more. The one in June is going to be for sure a 0.5 point, in my opinion. And I think August, September, we're going to be in store for either an adjustment or a stabilization. I do think, you called it a reaction. I think there's going to be a reckoning. I do unfortunately think that the result of printing that much money, it's just simple math. It devalued our currency. So inflation is, like, if the government is saying 6, it's probably 12. Because the rationing behind the way they audit it, etc., is just not the truth. Like we've all been to the gas station, we've all been to the grocery store. What used to be $250 grocery run is now $400 guaranteed. You go to the gas station, it's $1.80. Like we're talking about $180 to fill up your car. The kids still have to be dropped off. You're still going to do exactly what you did. And I can guarantee you your salary did not go up 40%. So it is a serious problem. However, all problems can be mitigated with tact. We are real estate investors. You are real estate investors in the audience. And if anybody ever wants to chirp or to chime in on this show, all you have to do is put up your hand. You can be brought in. This is not so this is a big conversation. When we own real estate, the number one thing that we have is real estate. Meaning with prices going up, the asset class, we're hedging against inflation because we're going up with it.
Well,
to those who have money in the bank, you're increasing, you're in parallel.
Yeah, and I know we're lagging between the two of us right now in terms of the internet feeds and stuff like that, in terms of the stream. So I'm going to try not to, and I know I'm really bad at it, so I apologize up front, not to try to cut you or anyone else off, because usually when we're not lagging, we can go back and forth and banter. So continue with your thought, brother. Sorry.
So my thought, Jazz, is I don't think we're at the end of it. I think it's going to get worse, the inflation portion. I think the government is going, so by the people who are involved, we do have tremendous talent in the Bank of Canada right now, as far as the quantitative easing being reversed to tightening and all the measures that they're taking in place. The mortgage rates have to go up this way in order to curb the consumer spending. I do think that if the job creation, the supply chain recovers as it is right now recovering, it is recovering. There are better news out there. I think if we're stable by the end of August, September, I think we're not going to see further hikes, meaning the market will find its way. And I mean the financial market as well. I'm not talking about the real estate. The advantage we have in real estate, as I said a second ago, is we're tied to everything. Market is not going down. Market is going to slow activity. Less people will be transacting, but the market is healthier than ever. As a matter of fact, it's a seller's market, which means it's problematic for buyers, and that is just going to escalate. That translation, meaning with less buyers being able to buy because of the interest rates, to our investors who have bought property, to all of you who have a portfolio, this is to the detriment of the non-buyer, to the detriment of the tenants at large. Rental rates are going to skyrocket right now. So to the investor community, unfortunately, I have to say, rejoice, because your rents are going to go up.
Well,
we've seen less people buying
in a lot of areas.
rental.
We've seen that in a lot of areas already, man. I mean, look, we've had a little over, just in the first part of this year, what are we in, month 5 now? We've probably done at least 100 to 150 rentals just within our organization. So our feet are really on the ground in terms of what, like, comparing numbers. We're not just pulling them from the Toronto Real Estate Board or market stats, which is, which is good in itself, but we're actually speaking to tenants. We're actually speaking to landlords. We're marketing these properties. We know that if we went a little too high from a landlord's perspective, how much we needed to drop it by, or if we started a little low, we got a lot of interest and then we started to get multiple offers on rents. But I mean, downtown Toronto, for me anyways, and I think you'll agree, Simos, is really kind of, it's like the sun, right, in the solar system, and then everything else, the Mississaugas, the Bramptons, and the Durhams, and all that is kind of the other planets, as I like to say, to the solar system. And when we look at Toronto from a rental rate perspective, when you go back to pre-COVID, a 1-bedroom condo, and that's kind of the metric that we like to use. What does a 1-bedroom condo rent for now compared to pre-COVID, or whatever it is, or what's our forecast going to be? So pre-COVID, a 1-bedroom condo, no parking, approximately 550 square feet. And I'm not talking like right in the heart of Yorkville. We're talking like, call it Spadina and Gardner, okay? Like what some would, in the industry, we call it kind of the concrete jungle there, where all those condos are. You've seen it when you're driving on the Gardner. 1-bedroom condo, no parking.
Oh, it's any place.
Yeah, 550 square feet, all day, multiple offers, line up at $2,500 a month, okay? And as we went into COVID, we started to see people leave, not wanting to touch the elevator buttons and all that kind of stuff, and go into, well, also the fact that they didn't need to be downtown because their offices were closed. We started to see that number drop to, I think it's safe to say, 1,850 to 1,900. Maybe some cases it even went as low as 1,800. Right now, Today, that number is at around 2,350 to 2,400. Are we at the 2,500 level? No, but we're getting very close, to Simos's point, because, and I want to go deep there, right, Simos, with what you said in terms of investors having the ability to rejoice when rates go up. And that's why real estate, and this is like completely biased, but based with some fact, It's why real estate is one of the best investments, right? Because rates go low, now the cost of borrowing is lower. You can go and purchase more property. Rates go up, your customers, which are your tenants, unfortunately for them, they can't buy. So if they were on the fence thinking about purchasing their first property, chances are they're not going to make that jump because the cost, the monthly obligation for them has gone up. And so rates, in terms of rental rates, I apologize, not mortgage rates, rental values, you're going to notice probably, I think, right around the fall market time, might happen a little bit earlier, but let's just call it the fall market time. I have a feeling it's going to surpass 2,500 for that one bedroom condo, 550 square feet. And look, as an investor, I think that's an amazing thing, because here's the thought, right? Like, yes, rates are going up. Your cost of borrowing as an investor has gone up. You're going to have a problem only if you're not thinking about this in a 10-year, 13-year window. The once you get yourself to the mindset of like, yeah, rates are gone up. Like, yeah, like what 95% of our personal portfolio has variable rates. So our cost of borrowing and our cost on a monthly basis has increased, but so has our equity. Right? Our equity has gone up significantly, even accounting for this, what we're going to go into a little, like very, very soon, in terms of the values dropping a little. When you look at it in that 10 to 13 year window, you as an investor have a massive opportunity to get in, because you're not going to be competing against the amount of buyers you were in the past 12 months.
It's exactly the case, Jazz. So I think what I want to really drive home today is to our investors. This is my message to investors. Not only am I going to reinforce what we've been preaching for over a decade, really, really loudly, which is hold your position. I want you to be prepared to start opening your eyes to an alternative market, which is going to be ahead of us, that it is up to us to define and mold the opportunities. An opportunity tomorrow is not going to look what the opportunity looked like a year ago. During COVID, there was a mass exodus out of C1, which is the downtown core. When we were renting out buildings there at $1,800 just to get them filled with nobody living there, those Jazz was just in their $2,300 today at their renewal. All those people who made $250,000 to $400,000 on a condo that they purchased 4 years prior are now not only cash flowing, they're cash flow positive. The majority. And if you're not cash flow positive, refinance it and pay the mortgage with your own money that was given to you by the market. So there's just way too many ways and avenues to explore to look at your investment. And if you don't see the sense in doing the things that I just said, because some people might say, oh, but that's robbing Peter to pay Paul. No, it's not. You bought an asset for $400,000 and it's worth $800,000. Refinance it? Don't refinance it. Pay off the mortgage. Sell it if you want to. But you didn't earn that $400K by working. You put your money down, you put a deposit down, you took a risk in the marketplace, and you were rewarded 500% overall in the last 5, 6, 7 year period.
And all you really needed to do at that time. You don't
see the real estate market as. Sorry, go ahead, Jazz.
I was going to say at that time, because we had 200 investors that we had to close and help close on those properties and rent out those properties at $1,800 to $1,850. And we did have, I'm going to say maybe 15 of them get really scared, and that's okay. And they sold. But really the others that continued on and held on to those properties, the mindset they had is like, look, I'll put in $200 a month easily. out of my pocket to carry it. Right. And that's kind of the mindset that we want everyone to have, because it's what we think about all the time. You might be sitting there thinking right now, oh my God, like I got to pay $200 a month out of my pocket. How fast, how quickly do you spend $200 a month? If Simos and I actually, for everyone, it's happy belated birthday to Simos. It was his birthday on Monday, and myself and him and the rest of the team, we went out. But within the first hour, we probably spent $400 with making sure that we were hydrated, I'll just say. And so how quick do you spend $200 just going out to watch a movie these days? You know, like it's $100 all day long with parking, popcorn, the movie tickets. But yet when we sit with investors and say, look, if you got to put in $200 a month, that's $2,400 at the end of the year. Worst case scenario, you got to do it for 2 years. We're talking about $5,000 in 2 years to see a return of 500% overall. It's a no-brainer. It's like completely a no-brainer, because there's really no other place that you're going to be able to see those type of returns in such a passive way. So I implore everyone, if you have a property right now that you have to put in $200 a month, find it. Stop close your Netflix account.
I'm gonna up the ante. Let's call it $1,000 a month cash flow negative. Call it $12,000 a year cash flow negative. We're not talking about fundamentals of real estate here. This is a strategy that you employ only in an urban setting that has massive supply and demand challenges. This is not something you can do in small town Saskatchewan, because you do not have the expected appreciation. So let's make this very clear to what we're saying to people. Right now, we know as a fact that Canada is on target with bringing in select immigration in the tune of 400,000 people per annum. We're not talking about refugees of war. We're not talking about people seeking asylum. We're talking about university graduates. We're talking about skilled trades that we are dying for. We cannot build enough homes because there is not enough crews to build. We cannot build enough highways because there's not enough trained people to do so. There's not enough people to get the oil out of the ground in Alberta because they're pounding away again. So when we know as a fact that the supply and demand is so out of balance, it is so out of whack, not the interest rates, not inflation, nothing is going to be safer than buying real estate in Canada for the next decade. This is a time to buy real estate. What asset class you choose, what method you choose, who you work with, how you do things, that's all up to you. But if you think real estate in 5 years from now or in 10 years from now is going to be as much as it is today, simply give your head a shake, go onto Google and pull up 100-year history of real estate in any country, all over the world, because it's not going to be the case.
I want to talk about a couple of things.
It is only when you sell, when you have a short-sighted vision, that's a goal, not real estate investing. Real estate investing has to be looked at in 5, 10, 15, and 20-year increments, period. Otherwise, you're speculating and trying to time the market. And as Jazz says it best, what do we do, Jazz? Do we time the market?
Time in it. Put time in it. Just put time in the market. You buy it, you don't wait to buy real estate. You buy real estate and hold. I mean, you guys have heard us say this. We sound like broken records. We really won't change our tune. And so if you're looking for something new in that sense, you came to the wrong place. The one thing that you will get new from us is exclusive opportunities. And this Wednesday, May 11th, is going to be our investors marketplace. Once again, it's back because that's what our clients have been telling us. It's the third investors marketplace. The last two investor marketplaces that we put on, one back in January of this year, and then going back to October of last year, collectively, we have initiated, well, you as the clients, our friends and family have initiated a little over $62 million in real estate. Over $62 million of real estate has been initiated in our past two investors marketplace. It's happening this Wednesday, May 11th at 7 p.m. Tyler, if you don't mind, just put it in the comments. It's recmarketplace.ca. Everyone that's watching right now, you should have got an email already. Unless you're new to us and you're not getting our emails, please check your spams or just go to REC Investors Marketplace. Make sure you reserve a seat. I looked at the numbers just before I got on today. We're getting a little close to 600 people. The last one, we had 1,122 people registered, and it was an amazing event. I brought 4 opportunities. I'm doing it again. We're going to bring 4 different investment strategies and 4 different exclusive opportunities only to REC insiders. And so it's going to be 1 hour. It's going to be 1 hour. There's the link, recmarketplace.ca, to reserve a seat. All done in 1 hour. Each of my guests are going to have 12 to 15 minutes to explain what the opportunity is, and you're going to have the ability to initiate a deal and take action that day. Our brunches like this are all educational, value-driven. I'm going to peel back the curtains. On an investor's marketplace, that's not how I roll. Your checkbooks are not safe that day. That's the day that you need to take action, because that's how you're going to grow your portfolio. So Wednesday, May 11th, 7 p.m. You can tell a friend as well, tell a colleague. Everyone is welcome. You don't have to pay to be at this event, but you will have to pay to actually see returns on your investment. Let's jump in.
That was a great segue in. That was a great segue in, Jazz. This Wednesday's marketplace, I think, is going to be more than likely one of the highest initiations we'll ever see. I know as a fact, there's got to be at least 50 people that I've spoken to personally that are waiting to pounce on the right opportunity. And I'm talking about we're having hundreds come on. So this is going to be great. There's a couple things that I want to touch on, because people call us crazy. Why do you tell your clients to not sell? Because you're in the transaction business. Well, we are real estate enablers. You want to dub me something? Call me an enabler. Because I don't believe real estate should be sold if you don't have to. Because the only thing you will ever do is win. We sell so much real estate to buyers that we don't need you to ever sell. We beg you not to. Just keep buying in any way that you can. And I'm not talking about being reckless. I'm talking about being intelligent. What we do here is enable you by educating you in ways to access capital safely, in ways to underwrite your portfolio safely, and do things right. But what Jazz was saying is, at this time, you have to do. So on Wednesday, whether it's after Wednesday, after you create your real estate action plan, it's time to move. This is the market that's going to cause opportunity like no other. I am telling you, we are acting on it. I am going through due diligence right now on 2 buildings downtown. I'm talking in the heart of downtown. Jazz is one of my partners, and another gentleman that you've seen many times before is another partner. And we are looking at due diligence of building a 16-plex in the heart of the city. This is going to cost a lot of money. We have to structure the financing properly. It's actually the financing that's going to make or break the deal, because the opportunity is great. But if we can't figure out how to make the money work, meaning that we can carry it safely, that it doesn't become uncomfortable for us, that we can get the work done on time, that we can get the rentals and the revenue that we need, we won't do the deal. So when you're coming to REC Marketplace, those are pre-vetted deals. Those are bread and butter deals. Get yourself a little unit in a transit hub, get yourself into a strategy that you wouldn't otherwise explore, whether it's student housing, whether it's senior housing, whether it's the excuse me, the opportunity du jour. Our job is every quarter to put on an event with things that you can participate in that you don't have to do 100 hours of due diligence, because most of it has been done for you, and you can simply come in and vet it. Meaning, you're giving my due diligence, let me look at it. If it works for me, this is factual, great. If it doesn't, great. That's what it's all about. And that to me is gold, and we hear it back all the time. If I'm proud of one thing, it's about these events that we put on and the feedback that we get. So I hope to see everyone at REC Marketplace. Well, I'm not going to be there because I talk too much, just like I just did. But that's why I'm not going to be there. But Jazz is going to be there, and he's going to present. I'll be in the audience. I'll pipe in.
Hey, it's interesting to see what people think. If you talk more or I talk more, who likes the sound of their own voice more? That's another one that we haven't tried. Simos, let's for the next 10, 15 minutes, let's just go through the GTA market stats, because they're very, very hot. They just came out yesterday, yesterday or the day before, I apologize. But why don't we go through the GTA market stats, and then we'll pick maybe Durham, Mississauga, Brampton kind of thing that we normally do. It's a beautiful day outside. I want to make sure our nation gets to spend it with their friends and family. You and I are going to be doing the same as well. Again, just before we go into the stats, make sure you go to recmarketplace.ca, because that's where you're going to hear about the 4 strategies. The one that Simos didn't mention really quickly is a way that you can invest your RRSPs and have all that work done for you. He didn't mention student housing. We are bringing student housing listings to the table, that they're actually like completely exclusive, not on MLS, nowhere to be found. We did all the due diligence on it. And really quickly, when you're talking about us doing due diligence and vetting our properties, this opportunity that myself and Simos are personally going to be in, hopefully being investing in downtown. I mean, that's probably cost us close to $20,000 already, and we're just in the due diligence process. Like the appraisers that are being sent, the architects that are being sent. I see a bunch of other invoices that come into our inbox, and so just so everyone knows, before we actually come out with the property, before we come out with an opportunity at a marketplace or any other way through an email where we're launching something, the immense due diligence that happens is truly second to none, because we want to make sure that our reputation is very, very high. For the people that have been in our community for a while, I know I'm not I'm not telling you anything new, but for anyone new to our nation, I want to make sure that you understand that we're not just a bunch of talking heads here, and that we don't have our feet to the ground. We're investors first and foremost, as we've mentioned a million times, even before being real estate brokers. But we also need to make sure that we sleep well at night, because we have a little over 11,000 people in our community now that have been cultivated and nurtured for 17 years, that we want to make sure our reputation is high. But Simos, why don't you get started with the GTA stats, brother?
So I think what's really newsworthy is the volume. Volume is down 40% across the board, which creates an interesting conversation. So I'm going to get into a couple of things. Overall GTA volume is down 41.4%. What does that mean? 41% less transactions than April 2021. That's what that means. The average price across the entire region is up 21%. So April 21 to April 22, volume, transactions are down, price is up. But what you find out through the micro markets, and when you dig a little bit more, because somebody can easily say, "Oh, market's down 40%." It's not. The market is up, and it's not up 20%, and it's not down 40%. What we need to see is we need to look at trends. And when I say we need to look at trends, we're investors, and we're trying to get something out of these stats that a different person is not. We're trying to find out is what's happening in the marketplace. If I look through these, Toronto is down 35% in volume. Mississauga is down 42% in volume. Brampton, 46% in volume. Oakville, 48%. And finally, York Region, 49.9%. So why is there a 50% disparity? Why is Toronto busier than York, which is Richmond Hill? Why? Because offices are reopening and there's people moving back downtown that moved to their mother's basement. There's people moving back downtown when they just saw the price of gas at $2 a liter with a 2-hour commute. All of a sudden, they don't want to do that anymore. What is happening is there is an adjustment in the market, just like there was when other circumstances happened. Right now, the opportunity is to catch some of that market. Right now, it's a time to be looking at transit hubs more than ever before. With the highways being the way they are, with the cost of transportation being where it is, this is what I see out of stats. I see that the city of Toronto is only going to double in size in the next 30 years, maybe even less at the rate that we're going.
And we're not going to see a lot
real estate position.
We're not going to see a lot more transit being built, right? We might see the LRT, and I mean, that's obviously happening, but when you can get close to subways, that's the key. That's the ticket, in my opinion. Because if you look at world real estate, and Simos mentioned it earlier, but if you look at world real estate for the last 100 years, values have always increased. Prices of properties as well as rental income have always increased the most in and around a major transit line. And so that's why I think Simos is going down that path, because obviously we're going to be introducing something on Wednesday that is going to have.
But you can see that. But just you can see people moving by looking at stats of real estate housing.
Yeah.
So you can literally see what a civilization is doing just by how they're acting. If the whole market overall is down 40% in transactions, but Toronto's 35 and Richmond Hill is at 50, that means people are not choosing Richmond Hill right now, they're choosing Toronto. And 15% across 10,000 transactions is a big number. You can see what the sentiment is. You can start understanding where opportunities lie.
If you pull up just show that piece of paper again, Simos, with the market stats. I want to just bring something up. These are our internal stats. Just put it up a little bit higher. There you go. There's a big red box there for a reason, because we always tell people that the most important stat that you want to look at, that's probably the most telling for sure, is the months of inventory. And it's been interesting to see. We've seen the months of inventory, start to increase. We're not as intense as a seller's market that we've been in, but we're still in a seller's market. Like, if we didn't go through the 6-month period, maybe even a little bit longer, maybe 8-month to 10-month period of seeing 2 weeks of inventory in a lot of the major regions in the Greater Toronto area, what we're seeing right now would be, we would still be like, oh my God, we're in an intense seller's market. It's just it's not as intense as we've just been through. But why don't you tell me what the months of inventory right now sit at overall in the Greater Toronto area?
So overall, we're at 1.64. Just to delve in a tiny bit more again, Toronto proper is at 1.5, Saga 1.53, Brampton 1.8, Oakville 1.8, and lastly, York Region 2.17. And that's no surprise. Richmond Hill and York Region, which is at a whole Aurora, Markham, that region is the most expensive region in the country, and it always gets a tiny bit of a hit first in every downturn or every market adjustment. And Oakville will see the same, only because the price point is unattainable to the masses. So when we're talking about the average price being 1.8 and $2 million, well, not everybody can afford a $2 million home. Let's just put it that way. So we're going to see the days on market go up a bit in those markets, but from a good news for the broker business and the industry, we are seeing showings come back up, which means people have accepted the new interest rates. They understand that there is no bottom falling out, and showings have picked up, because last month we had seen a 40% drop in showings, and that's simply people reacting to something, whether it's the war in Ukraine, the interest rate hike, this, that, the other. When people are scared, they just shell up like a turtle. We get into the shell and embrace for the pain. But then once the sun comes back out, we poke our head back out. So,
and now, just if you look back in the decades and decades of real estate, you'll always notice that the month of May, mid-April to kind of June, is where you'll start to see more listings anyways come to hit the market, the spring market, because homes just show better. And you can start to see the flowers and the trees and the neighborhood. Just picture yourself wanting to actually move into a neighborhood. You'll probably want to see it sometime in the spring and summertime, more the spring, because summer people are going away. So this is something that we're very used to. Overall, I mean, it's only been really the last 2 years, specifically year 2020, where people weren't putting their homes on the market because you couldn't get out because of COVID and the lockdown. But now we're starting to see a regular, a smell, a hint of a regular market coming into play now. And for investors, as those months of inventory start to increase, this is that time where you're going to see compelling opportunities, because you're not going to have as much competition. This is the best. If you were an investor who was actually out and about looking at properties, and you saw a property listed for $750,000, and then on offer night there was 62 offers and it sold for $912,000, I got some great news for you. That ain't happening right now. And so now is that time to go in and see what actually homes, even negotiations between brokers have changed, right? Like in that last year and a half,
oh, yes.
The way that they were talking to each other was, for me, it was just like, oh my God, like I miss the times where we actually had to sit at a table and have the meeting of the minds to actually put a deal together that was fair for all parties involved. Brokers now need to go back and do the research to see what comparable homes and condos have sold for, not this silliness of crapshoot, just like throw out a number and see what happens, because end users were getting mortgage rates at 2%, 2.5%. So it's nice to actually see. It's actually very refreshing to be part of.
There was a whole lot of cringe over the last few years, especially like I'll never forget so many conversations with just the most junior of brokers acting like they know what they're doing, and they just slap something on the MLS and it sells, and not realizing that they may have left tens or hundreds of thousands on the table for their client. Just because you got multiple offers doesn't mean you got what you should have. But just that fake confidence that sunshine instills in people when you've never seen a cloud in the sky, and you just think you're just king of the world and you're king shed. And really and truly, now where people have to work again, you have to call other brokers and ask them for their support, garner their attention, find a way to get my attention if you got a listing, because I have 50 agents that might be able to sell it. But if you treated me like a piece of garbage, you think I'm going to look at you? Message to all the agents watching REC Brunch. Give yourself a quick little chin check. Be kind.
Yeah,
be humble.
The
business always comes around.
100%, right? I mean, and that's why when you're on your way up, you gotta make sure that you don't step on people, because you might see them on your way down again, right? And so I think it's important for us to sometimes speak to our brothers and sisters in the industry as well, because we want to see them succeed. There's more than enough to go around. This ain't about REC Canada in itself. We're fine. We're good. We I think done a fantastic job with our clients. We spend this much time, like, let me just make sure I'm in the shot, like this much time on the competition, because we just don't have enough time for it. Like, it's not because we think we're too good or too cool. It's just we don't really have much time to worry about what other people are up to in our industry. We wish them all the success in the world. Reach out to any one of us or anyone on our team, in our leadership team, Laura, Tyler, Bobby, if you have any questions on how to better your personal brand and just how to connect with people better, right? Like, we can teach you how to put on events like this. I think it's safe to say that the reason we have a lot of confidence, and it's not cockiness, it's confidence, is because we grew this network of over 11,000 people that know us, like us, and trust us. We're not perfect. We still make mistakes. But the one thing that you'll always find from the two co-founders, and now it's starting to bleed in to those three people in our leadership team more than ever, that we're not going to shy away. We're here. We're here to pick up your phone call. You can have my direct line. You can have Seamless's direct line, and anyone on our leadership team. We're not perfect. I need everyone to know that. I like, we look perfect with our haircuts and our beards and stuff like that, but we're not perfect. We make tons of mistakes, but I want everyone to know and everyone to hear that we will not shy away from a phone call. And whatever your concern is, if it wasn't a positive experience, please let any one of us know, because we're here to fix this. Simos, brother, man, the weather's so nice out there right now, and I think that's where most people are wanting to be right now, and most people are, as restaurants and lounges and everything is open. I went to a restaurant yesterday. There was over, I don't know, at least 250 people there. It was so nice to see and be part of, not seeing any masks and all that kind of stuff, and people having conversations. It was so refreshing to see. But what did you want to just say, buddy?
I'm gonna close off. I have nothing else to say. I think we really hammered a lot of stuff home today from a real estate perspective. I just want everybody to please spend some time researching everything that you do. Everything that we say it's not new. It's not revolutionary. I just want to drive the message home. Be conservative. Take your time, but make sure that you take action at the same time. So Wednesday's a perfect opportunity for some action. Hopefully you join us at REC Marketplace. Today I'm spending the day in the sunshine. After 11 years, my outdoor dining table, after I uncovered the tarp, looks like a bag of nickels. So I bought a new one when it was Bay Days about 2-3 weeks ago. It got delivered. So I'm going to be putting together some outdoor furniture. And I'm going to be celebrating my beautiful wife for Mother's Day. The creator of all the creators of life out there, have a tremendous, amazing, happy, joyful, delicious brunch. Do what you need to do. But to all the mothers up in heaven and down here, happy Mother's Day. We love you. We appreciate you. And that's me. Love you.
All right. To my mom, to all the mothers, to my wife, happy Mother's Day. I did want to definitely get that in there as well. And I'll leave everyone with my thought process in terms of how I kind of run business, how I like to run my investments, and really how I like to run my life, which is ready, fire, aim. And I know that really screws with a lot of people, because we were raised to look before we leap and not pull the trigger until the full target is lined up. But what I found is the more consistently that you actually pull the trigger, you'll actually hit the target a lot faster, because you'll know if you're too high, too low, too much to the left, too much to the right. And so I say to you, ready, fire, aim. But that does mean that you aim, but you adjust along the way. Have yourself an amazing weekend. Make sure to go to REC Marketplace or just go into your inbox and take a look at the emails that have been sent to you. Get registered for our marketplace. This one is going to be insane because I know the opportunities that are going to be bringing to the table. A lot of people are going to be happy that they took action that day. I love you, Simos. Tyler, thank you so much for being in the comments. Mr. Stephen Rochester, you don't see him backstage, but he's the one who's controlling the ones and twos, and it's sometimes difficult to get
bring him to the backstage.
Lined
bring him
up.
to the backstage to say what's up.
Let's go, Simos. The thing with Stephen is who knows? He's probably now just stepped away the time that we say because he knows that it's on autopilot. Is he here? All right, Stephen, we love you. And to the rest of the REC Nation, thank you so much for joining us.
Bye, guys.